Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Mark Shore, Chief Research Officer with Shore Capital Research, and he's also the Executive Director at the Arditi Center for Risk Management at DePaul University. Mark is here to discuss if the Nasdaq-100 Volatility Index, what we call VOLQ, is a sentiment indicator. Mark, it's great to have you with us. Welcome to Trade Talks.
Hi, Jill. Thank you. Great to be here.
And have you found that volatility indices may offer some insight into the perspective of the underlying options participants?
Yeah, so I have found that it does offer some insight, but also too, just to clarify that VOLQ is a gauge of 30-day implied volatility. So when I look at this, I think about VOLQ as a sentiment gauge or an indicator of the option participants' perspective of the markets, right? So it's and more so of their downside volatility and uncertainty in that perspective.
And what is VOLQ pricing derived from?
So it's derived from at-the-money NDX options. But now when you think about it, so when equities rally, they tend to do it gradually over time. But when they decline, it can happen very quickly. You can see a really quick spike down. When that happens, you see a movement in put options, right? So you're getting a rally in downside volatility, which is what VOLQ is. So therefore, it has this negative correlation to NDX.
And Mark, what are some useful patterns that you have discerned from VOLQ trading that may offer insight into the underlying options?
So there's a couple of items here. So one of them is that as option traders become more uncertain of the markets or believe that there's some sort of correction that's occurring, you'll start to see VOLQ rally. And I'm not talking about big rally, but it's kind of slowly creeping higher. And so when it does that, it's really giving you some sort of idea towards the sentiment of the option traders so that there may be something that's changing that's going on there. Now, something else that can also occur kind of on the opposite side is that when VOLQ tends to sit the bottom end of the trading range for extended periods of time, I refer to this as the compressed spring effect. And I'm calling it that because if you think about a spring, right? So when you have a spring and you compress it and then you let go, it makes a big pop. If you think about volatility, when you compress it for a period of time, and this is often when people start to become complacent in the markets, or there's greater certainty, or there's greater optimism in the markets. And it's also times when you may hear people talking about that valuation is overdone, right? Things are overvalued. So you have this compressed volatility, and then it breaks out. And so that I refer to this as the compressed spring effect.
Right. So Mark, to recap, what are the two major components volatility indices tend to have?
So one is that they tend to be range-bound products, right? There's a top and a bottom. You pretty much know what they are. In the case of VOLQ, the bottom range is somewhere between 10 and 14. The top range is probably mid or low to mid 20s, and it can break out above that, right? So currently it's been in the 30s. Go back to March 2020, it was about 78. But it tends to stay within that range. So you can think about it like a spread trade, right? Because spread trades are range bound. They tend to stay within that range. They're mean reverting. And you're always thinking, is it overbought or is it oversold? Another component to this is that when they do break out to the upside, the indices, the volatility indices, it can move very quickly. It can peak out. But to come back down to the bottom range, it can take weeks or months or longer to get back down there.
Right. And actually, I wanted to follow up with you on that. When we talk about picking the tops and the bottoms in stocks, which we know is an exercise in futility, it's almost the same thing too. When you think about volatility indices, it's not a self-fulfilling prophecy that it's always going to mean revert. You still have to take your time and see how it plays out and how these ranges are established, similar to what we see with equities, right?
Yeah, that's a lot of what happens. Like, so when it's sitting at the bottom, you don't really know when it's going to break out, but the longer it sits there, you know it's becoming more compressed. And so there has to be this point where it does break out.
All right, Mark, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.